Hi, everyone. My name is Paul Zimnisky. I'm an independent diamond industry analyst. I will be presenting to you from America today. I'll be talking about the supply-demand fundamentals of the diamond industry and how that relates to prices. I want to thank SAIMM for inviting me to participate. It's a pleasure to present for you all. Hopefully next time we'll be all together in South Africa. I'm very much looking forward to traveling again soon. This is my disclaimer. Please read through this. And if anybody has any questions on this, feel free to reach out to me directly using the contact information below. So starting with upstream supply, talking about the diamond miners and the supply that they're producing here, I think it's important to understand that the market was, at least in my opinion, oversupplied for much of last decade. I think this was at least in part a result of higher prices that we saw earlier in the decade. In 2011, rough diamond prices made an all-time high. I think that led to exploration and development that ultimately led to new supply. That was more than what the market needed towards the end of last decade. I think now we're seeing the opposite effect happen, where relatively apathetic prices in recent years have really reduced the amount of new development of mining assets and new supply. I would say, diamond supply hit, at least a recent high water mark in 2017. 3 new mines commenced production that year. Supply has subsequently declined on a year-over-year basis in the following years. And last year, I would say the pandemic accelerated this decline. And in 2020, diamond output, based on my analysis, was the lowest since the 1990s. So I think what that's done is it's led us to a much more balanced, healthier market. Looking to this year, I'm forecasting that production is going to increase a little bit on a volume basis year over year. But we're still going to be well off that high water mark hit in 2017. I think it's also important to note that miner inventory levels are the lowest they've been in years. Just a few weeks back, Alrosa, which is the largest diamond miner on a volume basis, at least, they said their current inventories are reaching deficit levels. I think this has to do with supply chain disruptions last year, combined with what was a better than anticipated second half of 2020 for diamond demand. There's been relatively healthy, end consumer demand for diamonds, and the manufacturing and the upstream segment of the industry have been trying to keep pace with that demand. And because of that, the major miners have unloaded a lot of inventory, in late 2020, and that's continued thus far into 2021. And again, I think it's important to understand the dynamic between price and supply. Again, we saw strong prices early last decade, and I think that led to new exploration development of new assets that came online towards the end of the decade. And I think that did lead to an oversupplied market, and I think it's kind of put a ceiling in prices in recent years. But I think now we're actually seeing the opposite happen, where relatively lower prices is actually led to less supply, which is now beginning to be supportive of prices. As far as looking further out, again, there's very little new mine development or new projects in the works. So the Washe mine in Angola is the only major commercial mine that's going to come online in the next few years. We'll probably see that reach full commercial production middle of this decade. I think it's also worth noting that De Beers is investing billions of dollars to extend the life of its 2 primary mines in Botswana. And this is a chart of my forecast for diamond supply out to 2026 over the next 5 years. The black dark line is the actual production. The blue solid line is my current forecast, and the blue dotted line was my forecast before the pandemic hit. And I show this so you could see the impact that the pandemic had on supply in 2020, and that's going to continue somewhat the next couple of years. And then I think by 2023 we'll kind of get back to the supply trend trajectory that we were kind of headed towards before the pandemic hit. But you could see, over the next 5 years, and probably even beyond that, global output is going to be lower than it was in that 2016, 2017, 2018 period. Moving on to midstream, these are the manufacturers and polishers, the wholesalers. It's basically the segment of the industry that handles the supply from the miners and ultimately delivers it downstream and to the end consumers. As I mentioned with the mining companies, the midstream segment as well has been oversupplied in recent years. But I think we're now starting to see the excess inventory held by the midstream also begin to normalize. So I think across the supply chain, we're really starting to see inventories approaching much healthier levels. And that's for, I would say, mostly industry specific reasons. We're looking at the manufacturers. There's been structural changes that I think has made that segment of the industry stronger. There's less credit availability, which has led to less speculation, I think, which has allowed for much more balanced supply demand in that segment of the industry. And just a few examples of what the midstream's doing. Last year in the midst of the pandemic, the large manufacturing bodies in India, which manufactures the large majority of diamonds in the world, probably in excess of 90%. They called for a voluntary import ban on rough diamonds, in an effort to try to sustain manageable levels of inventory when there was uncertainty because of the global lockdowns during the peak of the pandemic period. And I think that was a sign that the industry is taking note of some of the mistakes that it's made in the past, and they're trying to be proactive and trying to avoid issues of oversupply. And I think this kind of somewhat ties into this as well, talking about the miners and the way that they're working with the manufacturers. They are trying to, I think, do what they can to try to avoid oversupplying the market. And last year when we saw the supply chain frozen, the major miners really tried to work with their rough diamond buying clients to try to limit excess supply in the market. And I think we kind of are seeing the effect of that now, where we have a much more healthy supply demand balance. But I think the miners have made it pretty clear that the new strategy, and hopefully this will continue, because I think it makes for the best for the industry as a whole. But the idea of a price over volume strategy, which I think ultimately what they're saying is we rather sell less diamond volume into the market, but be able to maintain prices or raise prices versus the other way around, which is I think what we saw in recent years. Just another point that might be worth mentioning, De Beers in their latest round of new contracts with their customers, it seems as if they're making moves to try to allocate the rough more efficiently to the manufacturers, again trying to keep the right amount of supply in the midstream segment of the industry, and trying to avoid over speculation by certain participants. And this is a chart showing change in inventory held by the miners and the midstream segment as a whole. The key takeaway here is, on the right side, that's the midstream inventory. Significant deleveraging of excess inventory kind of started in 2018, and we definitely saw that continue last year. The miners in 2020, during the lull, in the midst of the pandemic, when the supply chain was frozen, these companies did take on inventory versus forcing it down the supply chain. But as demand returned in the second half of last year and into 2021, sufficient demand has allowed them to unload that excess inventory. And I would say over the last 2 years combined, the mining segment, that's again the left side of this chart here, they've net unloaded inventory, which is again, I think a sign of health for the industry. Looking at demand here, demand I think has surprised a lot of people. You know, especially in the second half of last year, we had you know, jewelry stores globally closed for multiple months last year in the midst of the pandemic and the lockdowns. China was the first market to close, but also the first to reopen. And I would say demand coming out of China for diamond started to show signs of being very strong in the second half of last year, and that's continued into 2021. A lot of that, I think, is a result of domestic consumption in China, whereas you know, luxury consumers in China in the past would be you know, traveling to destination markets to buy luxury, but because of the lockdowns, they're buying at home, and I think that's led to a significant increase in diamond consumption by Chinese consumers in particular. The U.S. market is actually showing signs of strength as well. It was I would say a better than expected holiday season in late 2020. And again, that's continued as well into the new year. And I think this is a result of just pent up demand where, you know, people they want to get out and spend and do things and treat themselves to things that make them feel good, combined with stimulus and combined with still restrictions and experiential activities like dining and travel and going to movies and concerts and sporting events and that sort of thing. So, you know, in that way, I would say that, you know, diamonds have benefited when you look at the type of luxury consumption versus, say, a material item like a diamond versus an experiential item like a travel or dining out. You know, looking at demand longer term, you know, to kind of provide some context here, the U.S. is probably the largest market in the world at 50% of global end consumer diamond demand. China and India are the fastest growing markets. I would say combined, China and India represent about a quarter of global diamond demand right now. But given the growth rate, I think, you know, there's definitely potential for those two large growth markets to outpace the US, you know, possibly by the end of this decade. So, you know, China, India, definitely the big growth drivers for, you know, end consumer diamond jewelry demand. Just a couple other items that I think are interesting to look at. When you look at, you know, the way that the diamond retail experience is changing right now, jewelers globally, they're incorporating omni-channel strategies. And this is essentially trying to combine online with in-store shopping experience. So consumers can kind of go online, do research, kind of understand the product that they're looking to buy, but then actually go in the store and see for instance, the physical diamond and try it on and actually do the purchasing in store after all of the research was done online. So I think there's definitely a move to trying to combine both of these sales strategies, the online and the in-store, to make it more conducive to you know, the changing customer. You know, talking about demand, you know, another important item here is marketing, and I think marketing at the end of the day is one of the most important demand drivers for diamonds and luxury in general. And there was a lapse in category of generic diamond marketing for about 10 years, I would say, between, you know, probably around 2008 to 2018. And then, you know, we saw in recent years, we saw an effort to reestablish generic diamond marketing through the Natural Diamond Council, which is a combination of the largest diamond miners in the world kind of working together to reestablish generic diamond marketing. And these strategies are up and running now, and I think they're growing. I think we're starting to see some positive effects of these strategies. And I think it's the right thing for the industry to do. I think at the end of the day, this market needs to be, the industry needs to be marketed properly to consumers. It needs to be marketed sufficiently. And the lapse in marketing, I think, was certainly felt by the industry at large. And I think making investments to market diamonds in a more generic or category way is definitely the right thing to do. And I think we're going to continue to see the benefits of that. Looking at how diamond supply demand is influencing prices, in the midst of the pandemic last year, if we look at rough prices, they were down, as much as 25% in my estimation. There weren't a whole lot of transactions taking place. These were companies that needed to make sales to generate cash flow. At that time, the mining companies that were probably more capitalized were not selling, in the thinnest market in the midst of the pandemic. I would say that was March through July. So the trading was light, and the trading that was happened was at relatively significant discounts. But the major miners didn't force supply into the market. They instead built inventories, which was, I think, definitely the right thing to do. And they had the financial capacity to do that. And I think that's why, when we look at the fundamentals right now, the market is emerging as well as it is. I think it's because of these actions that the industry took to not oversupply the market. Talking about, destocking, again, there was excess supply, in terms of inventory held by the miners from mid-2020. The manufacturers have been deleveraging for a few years now, but it seemed as if holiday demand in 2020 was good enough to clean out most of those excess inventories, and the restocking that took place in 2021, I think, has put an industry in a place where probably the relative supply is probably the lowest it's been in probably a decade. Looking at where prices are right now. According to my proprietary index, I have rough diamond prices up about 9% year to date 2020, and we're now above the pre-pandemic levels. And this is a price chart of showing performance of different categories. The thin black line is the small goods. The darker gray line is kind of what I would consider maybe more of a medium-sized good. And then when you look at the blue and the lighter gray, these are the larger goods that are in excess of 3 carat, and they've definitely been outperforming. And I would say, based on this analysis that I did, prices of those larger goods at least are back to where they were in 2014 levels. And just a couple quick words here on man-made diamonds. My prediction is that longer term, there'll be a bifurcation between natural and man-made diamonds. And I think this is going to be a result of price differential. 5 years ago, man-made diamond maybe sold for 10 to 15% less than a natural diamond. Now you can find them for, as much as, 75 or 80% less. I think a lot of this has to do with the fact that, man-made diamonds are a manufactured product. The technology to produce them continues to improve. We're seeing more goods on the market. And it's a manufactured product, so the supply is ultimately unlimited in nature, whereas natural diamonds are limited by the geology. So I think at the end of the day, that dynamic is going to continue to lead to the price differential between natural and man-made diamonds widening. And I think that price differential is ultimately going to influence the way that consumers see the two products. I think the other key to this is marketing and branding, and I think a lot of how this turns out is going to be a result of not only how the man-made diamonds are marketing their product. The man-made diamond producers are marketing their product to the diamond consumer, but also how the natural diamond industry does with marketing its product. So I think marketing is going to really be key here. But again, the price disparity continues to widen, at least if we're talking about generic diamonds. I think there will be companies that try to cater to the higher end market, and they sell their man-made diamonds as a branded piece of jewelry. Say that's made with 100% renewable energy, or something else that differentiates their product from the generic. So I think there's going to be bifurcation between man-made and natural diamonds going forward, but I think there'll be further bifurcation between branded and unbranded man-made diamonds going forward. So I think there's going to be multiple segments, and I think the branded man-made diamonds that are going to probably sell at a higher price point will be the ones that compete more with the natural diamonds. And this is just a chart showing the price differential between natural and man-made diamonds. So you can see the trend is definitely down and to the right. And this is ultimately the discount of equivalent natural and man-made diamonds, generic diamonds specifically. So with that, I'm going to wrap it up. There's not going to be a Q&A session today, but if anybody has any questions, you could feel free to reach out to me directly. I'll be happy to get back to you, and enjoy the rest of the conference. And again, I hope to see everybody in person again soon. Thank you.